Weekly and daily chart combination. So without any support or resistance zones on your chart, we can already plan our next trade. If our 633 and 200 period moving average are above the price, this makes us more comfortable in trading short opportunities below the EMAs. Bear in mind, if we are trading long, which is buying against this idea, then you can use these EMAs as a potential target. When the 36 EMA and the 12 EMAs are interwound, then this is indicative of a ranging market. On the other hand, when the EMAs are fanned out like this, then we are more likely in a trending market on this particular time frame. The next step is to draw in our support and our resistance lines. This way we are identifying our playing field. Now in our example, we have a 300 pip playing field. The support and the resistance together with the EMAs acts as a potential targets and potential entries for trades. Now we wait for price to come up close to our identified resistance. And in this case, it has a nice confluence with the 200 period moving average. We also know that prices are more likely in a range because we have our 36 EMAs and our 12 period EMAs interwound. We can switch to our standard chart now and look for a beginner strategy method because we are in a ranging market based on our Heikin-Ashi analysis. So the excursion beyond the mean identified by the envelope in an area of importance, this is something we could look at on the standard daily chart now. So typically I would look for my first entry on the classic charts. After I've done my top-down analysis on the Heikin-Ashi charts and after my playing field has been identified, I switch to the standard chart, look for the beginner strategy, excursion beyond the mean, beyond the envelope in an area of importance, and now suddenly this becomes an even more important area because of what I've analyzed on my Heikin-Ashi charts. You see, it's exactly the same areas that being identified. More confluence, more eyeballs on a particular area, the better the potential of a good entry. Now I'm going to assume that the market, after I've taken a trade up here, I'm going to assume that the market is going to go in my playing field and it's going to be trending all the way down to the support level, which has also been previously identified. This support level has now become my next target, my next goal. So my first step would be to identify a trend line break on the daily chart. This is the weekly chart view and this is my zoomed in daily chart view. So after a valid trend line is broken on the daily and the EMAs are crossing over, showing a change in direction, I switch to the 4-hourly chart. This here is the trend line coming from the daily. This is a zoomed in 4-hourly chart. And we've noticed that the trend line is breaking. So we watch for this trend line to break. Then we look out for a retracement. In other words, we want a break and a pullback. These pullbacks are all trying to get us a better price. So it's a break and a pullback. And then as prices are approaching this area, we are now looking for another entry based on a stop hunt or a manipulation, but always bearing in mind that we have already taken our first position over here based on our analysis on the weekly and based on our excursion beyond the mean. So this is our second entry, trying to get all the way down to the 300 pip zone. Remember, we have identified a 300 pip playing field here. So how does prices get down to the next level? We are going to assume that they are trending all the way down. So on the 4-hourly, the first step is look for a trend line break. And then our first break, pull back on the 4-hourly, we would look for a manipulation in that area to trade prices going short. Now, the highest probability win rate is when we take the first break pullback visible on the 4 hourly after the daily trend line has broken.